right, welcome everyone to Canadian Taxes 101. Um, I used to do a lot of teaching on personal finance a couple of years ago. And I would say over the past year, I stopped because, as we'll talk about some more, I was focusing more on retraining and getting my therapy practice off the ground. And so now that all of that is up and running, I'm just so excited to get back to teaching about personal finances, especially given a lot of the things that I've been seeing in the news and things that people are telling me, even in my practice, the conversations that are coming up, a lot of them center around money. So I'm really excited to hopefully make this more frequent, having talks like this more frequent. So for anyone who is watching and we are meeting for the first time, my name is Yewande Fadojutumi. I am a medical doctor. I used to work in high stress, high acuity ICU and ER environments. I did that for about 10 years of my career. And as I said before, over the past 2 or so years, I've retrained as a therapist and just opened my counseling practice a few months ago. And something that comes up very often, as I said, in my practice is stress around money. And so I like to say that I sit at the intersection between money and mental health. And I often bring, just budgeting, addressing financial anxiety, all of that in my practice. But today, I am operating in the office of a financial literacy educator. And all that means is I simplify the language of money. I love to say that I'm able to break down concepts that people might find overwhelming and confusing and make it simple and more accessible. And so welcome. And if you have any questions during the course of our talk today, feel free to unmute. Feel free to drop them in the chat. This is very informal. Go ahead and ask your questions as they come up, okay? All right, so why are we here? I really want to make sure that we all leave with 3 main points of understanding. Number 1, to understand the Canadian taxation structure, because I find that there are a lot of misconceptions around the Canadian taxation structure. I'm going to talk about tips for filing on time and then how to maximize your tax returns. That's sort of the general objective of today in no particular order. And I'm just going to be going in no particular order, but that's really the general object. I should say I'm not going exactly in the order that the objectives are listed out, but that's hopefully by the end of today, you'll have all of these objectives written down under your belt and good to go. It's March 3rd now, and so we're in tax season, and I thought that this would just be a good time to talk about it, especially since one of you ladies had requested it on Sunday. So this is just perfect timing to talk about taxing. So thank you, Fumibi, for requesting this topic, and we'll get going. Okay, so the truth of the matter is that your taxes are going to probably be your biggest expense, right? They're probably going to be your biggest expense overall. I'm talking about the average Canadian. Some people might think, okay, what about my mortgage? What about childcare is also expensive. Groceries are also expensive. But over the course of your lifetime, taxes, I should say, have the potential to be your biggest expense. But hopefully by the time you leave today, you will have some tips and strategies, because our ultimate goal, and this is one of the key secrets to building wealth, is to avoid paying more taxes than you have to. Now, I want to be very clear. Okay, first of all, I'm not an accountant. I'm also not a financial advisor. My role here is strictly in the office of an educator. So you would still have to go back and do your due diligence. But today, I really want to emphasize that, yes, we must pay taxes. Like, this presentation is not about tax evasion, but legally, how can you do what the wealthy people do in order to minimize your taxes? You really don't want to be paying more taxes than you have to, because the government has put so many things in place to help us to minimize the taxes that we pay on a year-to-year basis. So the first thing that I really want to emphasize is the importance of filing your taxes on time. It's so important to file your taxes on time. And the reason being is that the government will fine you 5% of what you owe, what your balance is. So say you haven't paid anything at all, or maybe you paid half, right away, the government is going to fine you 5%. And 5% might not seem like a lot, but if you think about, first of all, the amount of taxes that you owe, and second of all, what you could be doing with that money, right? It's really, really significant. And on top of that, they're then going to fine you 1% for every month that goes by that you don't pay your taxes. So your paying taxes on time is really important. And of course, the CRA is linked to, if you don't pay on time, it might affect your credit and all of that. And so you really don't want that to happen. So it's really important, in addition to the fines, in addition to knowing that you need to file taxes, it's important to file them on time. So the first set of things I wanted to talk about are filing on time. So what can you do to file on time? And honestly, in order to file on time for next year, you actually have to start preparing from this year, right? So in order to file on time this year, you would have started preparing last year. So preparation and staying as organized as you can is really the key, so that by April, you're not scrambling around. You have all the paperwork that you need, the documentation that you need. You're not having to request things at the last minute and maybe they don't arrive on time, and then you end up filing late, or you're staying up at night trying to get your taxes in on time. But if you have everything prepared ahead of time, it's so much easier to just gather all the documents that you need, file your taxes, and you're good to go. So what are some key dates that you need to keep in mind? This will change from year to year. So the exact dates will change from year to year. But for this current tax season, we're filing for 2022. We're in 2023 now, so we're filing for 2022. And for this current tax season, the deadline for filing is April 30th. Okay, so usually the deadline falls towards the end of April. The deadline for filing is April 30th. April 30th falls on a Sunday, falls on a weekend this year. So technically the deadline is going to be May 1st, but I encourage you, of course, to file and complete your taxes way, way, way ahead of that time, so that, again, you're not scrambling. So in addition to filing your taxes on time, you have to pay on time. So for those of us that are going to be owing taxes, or if you think you're going to be owing taxes, this is another good reason to get ahead of filing your taxes, because you have to pay all your taxes also that's owed by the end of April. So again, this year it's April 30th because it's a weekend, May 1st. So you file your taxes ahead of time. When you get your tax returns or your notice of assessment, and you learn how much you owe, then you pay on time. So this is very, very important. You file on time, you pay on time. Now, a couple of caveats. If you are self-employed, or if your spouse is self-employed, there's a little bit of a grace period, right? So they give you more time to file your taxes. And the deadline this year is June 15. Okay, so if you're self-employed or your spouse is self-employed, you have a little bit of a grace period. Having said that, I would still encourage you to just get your taxes filed on time and get it out of the way. Now, in my experience, again, I'm not encouraging you to file your taxes late, but in my experience, if you know ahead of time that you're not going to owe taxes, or the government is actually going to owe you money, there is a grace period as well. It's just not advertised. But in my experience, just in asking around and researching, if you end up having the government owing you, they're not in a rush to pay you back. So they give you a little bit of grace period in filing your taxes. But again, I'm not encouraging you to wait to the last minute, file your taxes as soon as you can. So you would have actually been able to start filing your taxes as early as February 20th of this year. So some people may already have their tax returns because they have filed it as early as February 20th. So sometime around mid-February is when everything opens up for filing. The deadline for filing, the deadline for paying is end of April this year, April 30th. But if you're self-employed or your spouse is self-employed, there's more grace period, and the deadline for filing is June 15th. Okay. So in order to file on time, what are the documents that you need? If you're going to be using a software or an accountant, usually they're going to send you paperwork or ask you for paperwork. But like I say, because we are now preparing for 2020, for next year, filing for next year, now is the time to be aware of the documents that you need so that you can gather them as they come in, you know where everything is, you're keeping track of everything, and that will make your filing come 2023 very easy. So some basic things that you'll need, of course, you'll need your social insurance number. You'll need your social insurance number for yourself, and if you have kids, your social insurance number for your kids, if they have them. Most of them will. So if they have them, you would need that for them. And why does the government need that? They need that to be able to decide if you qualify for certain tax credits or tax benefits, which we will talk about. So they need the social insurance number for the kids that you have. For example, Canadian Child Benefit, that is determined by the number of children that you have. Okay. You'll need your former, if you moved in the last year, the year prior to the year you're filing, you'll need your home address, your former home address. You also, and if you sold the house, you'll need the information around, how much profit you made, or if you made a loss, and all of that. You'll need all that information. If you have a spouse, you'll need your spouse's filing information as well. So usually they will want some their gross, I think it's their gross, their net income. They'll want their net income, and that can be found on a notice of assessment. And this is for the previous tax year, okay? So it'll be for when your spouse filed last year. So right now we're in 2023, meaning that they'll need the notice of assessment for taxes for 2021, okay? Because in 2023, we're filing for 2022. And usually all of that will be listed out in whatever program you're using, whether you're using a software or whether you're using some of the other things that I'm going to talk about later, okay? And like I said, preparation ahead of time is so important. So as your tax documents are coming, whether it's receipts for childcare, tax receipts, charitable donation receipts, all of those things, usually they start to come around, January or so, end of December/January. But sometimes they come even in the middle of the year. So as they're coming, just make sure that you have a safe place, a file folder or something that you can put everything together so you're not scrambling and looking for things and missing things at the last minute, because what often ends up happening is you miss out. You miss out on tax credits, you miss out on deductions because you're not organized, right? So even just a file folder that you can just put everything in as they're coming, so that way you have it accessible and readily available come tax time. What else are you going to need? So in addition to the documents, you'll need, of course, this is income taxes we're talking about, right? So you'll need to know what your income is. Usually for people who are salaried and get a consistent income, that's very easy to figure out. Bonuses are also included in this as well. And usually your employer will send a T4 that will break down your income and all the things that are required for filing your taxes. However, if you're self-employed, especially if you're not yet incorporated, because if you're incorporated, your accountant will usually be issuing like a T4 for you that tells you what your income is. But if you're not incorporated, it's on you to keep track of your income. It's on you to keep track of your income. And of course, it's better to do this as you right now. So you're doing it, we're in March now. It's better to start keeping track of your income now so that come 2024 and it's time to file your taxes, you have everything that you've earned over the course of the year. You're not having to go into your inbox or email or, check your phone or chats to see where your income was coming from. Everything is nicely put on. It doesn't even have to be a spreadsheet. If you like tracking things by pen and paper, just have your notebook, have everything there so that when it's time to go back, you know where everything is. But of course, if you like spreadsheets, definitely use that to track your income. It's important to note that in addition to your employment income, your self-employment income, foreign sourced income needs also to be declared. Okay, so if you have rental property in other countries, that has to be declared. If you have investments in other countries, or if you're earning income from another country, that has to be declared. But the thing is that you don't have to worry about getting taxed twice, depending on where you are. So for example, if you're in the United States, Canada and the United States have an agreement. So say you have rental property in the United States, just as an example. Canada and the United States have an agreement such that if you're getting taxed in Canada, you will get taxed in the United States. Or if you're getting taxed in the United States, you will get taxed in Canada. But at the end of the day, it's still important to declare all your income sources. In addition to foreign sourced income, self-employment income, employment income, your investment income will also have to be declared, right? And so investment income, I should clarify, if you have a registered account, which we're going to talk about at the end. So if you have a tax-free savings account, if you have an RRSP, so a registered retirement savings plan, if you have an RESP, so registered education savings plan, whatever income, obviously, I mean, not obviously, because it's not obvious, but a lot of people realize that money with all your, remember to mute, ladies and gentlemen. I can hear some background noise. So if you're not muted, then let me try. Okay, thank you. All right, so I'm going to talk about registered accounts, but say you have a high interest savings account, which I often recommend. I definitely recommend that you have one. Any interest that you accrue on your high interest savings account, that also has to be declared. Whatever bank you use or savings institution that you use, they will send you what's called a T5. They will send you the tax document. So you will know how much interest has grown over time, and you would submit all of that along with your taxes. So any investment income that is outside of registered accounts, which I'm going to talk about, high interest savings account, or say you have an RBC account and you use their e-savings, high interest e-savings account, whatever interest you accrue there is also considered income that needs to be taxable. If you have rental property, again, that income is taxable. And then if you withdraw out of your registered account, so your RRSP, if you withdraw out of your RESP, say it's time for your kids to go to school, for university, and you start withdrawing that money, that's also considered income. All right, any questions before I move on? Okay, I'm gonna move on. So how do we maximize our tax returns? How do we maximize our tax returns? This goes back to what I said about being organized, because when you have all your receipts, then you're able to maximize your tax returns, and this is how you do so. So the Canadian government is very kind, somewhat kind. Taxes are quite high in Canada, but the good thing is that they offer deductions and credits. And I believe there are about over 400 different tax deductions and different tax credits that are available to us. So some will be available to some people depending on your situation, and some will be available to others depending on your situation. So this list I have here is not a complete list, but it's some of the more common tax deductions and tax credits that are available. I'm going to explain the difference between tax deductions and tax credits shortly, but your GST and HST, so goods and services tax, and then the combined harmonized tax. Not all provinces have both of these taxes, but if somebody is in a low income family, the government will automatically apply this credit to offset whatever taxes they pay on goods and services, harmonized tax, etc. If you make charitable donations, you're also eligible for a tax credit as long as the organization is recognized as charitable. So say you have a family member that needs help and you give them money, that wouldn't be considered charitable donation. So it actually has to be an organization that is registered with Revenue Canada as a charitable organization. Self-employment expenses, right? So if you are self-employed, if you're a business owner, so things like your professional dues, things like your equipment, for me, my scrubs, my stethoscope, my lab coat, my pens, for CAMI counseling, the furniture that we use, the decor, all of that is considered self-employment expenses. If you're a healthcare professional and you pay overhead, say you are an associate and you pay overhead to the owners, the partners, usually they will take maybe 30% or 20%. That is also considered an employment expense and is tax deductible as well too. If you work from home, I think there's a criteria to how many days of the year are considered work from home, but you can actually get a credit based on your square footage of the house. You can get some for your internet, your phone bill, heating, utilities. So that's all considered work from home expenses, right? And so that would also be considered something that you need to keep in mind to maximize your tax returns. So your registered retirement savings plan, your RRSP. So the more you put in your RRSP, the less your taxes, the less income is going to be taxed. And we're going to talk about that more. If you've moved from one province to another or one place to another, there's a limit to how many kilometers. So if you've moved for work, that's also tax deductible. There's a climate action incentive. So if you're married, one of you would file for that, would include that credit. Medical expenses, Canada Child Benefit, that's income dependent. There's a child with disability, whether it's hearing impaired or hard of hearing, blind, autism, there's a child disability benefit that is available as well. Childcare expenses. So this is why keeping your receipts for your nanny, if your nanny is for your nanny, your daycare, right? Those are all tax deductible. For the nanny, I believe that if it's under the table, then that doesn't count, meaning that if you're paying cash and you don't offer receipts and are, some of those sort of more informal nannies, I'm not sure that those are tax deductible, but be sure to speak to someone about that. But in general, any child care is tax deductible. Apart from the child disability, there's a general disability credit. If you're a student, there's a tuition tax credit. And then business losses. So say you are just starting a business and you didn't make a profit that year. You can also get some tax deductions based on that. A lot of people do that if they have real estate investments, and so maybe the cash flow of the property isn't meeting up to, maybe they're basically taking a loss because the income from the rent is not enough to declare a profit. That is actually tax deductible as well too. All right. And like I said, feel free to interrupt me if you have any questions. So I just wanted to explain this concept of tax deductions and tax credits because it's important to understand why they are important. Okay, it's important to understand why they're important. So tax deductions basically the goal is to minimize the income that the government takes money from, right? Because at the end of the day, the tax is a percentage. And so if you have a high taxable income, the percentage that the government takes is going to be high. But if you utilize your deductions and continue to shrink your taxable income, the percentage that the government takes at the end of the day is going to be low, right? And so this is why knowing what tax deductions you're eligible for is very important. So that way you can maximize them. So like I said in the previous slide, some examples are childcare, business expenses, childcare, business expenses, if you're moving for work, that whole list that I talked about before, it's important to submit all of that so that when you now start to shrink your income, the taxable income is low, okay? So after the deductions have been taken away, that's when we now apply the tax credits, all right? That's where we apply the tax credits. And the goal of the tax credit is, again, to minimize the taxes owed. So by the time the government has calculated your taxable income, then we start taking away credits or giving credits, I should say, in order to then shrink how much you owe. Now, some of these credits are actually refunds, meaning the government will give you money, and some of them basically just remove your taxes owed. They don't actually give you money, but they reduce your taxes owed. And so in a situation where you're getting refunds, it's conceivable to think that maybe you don't owe the government any money, but they might end up refunding you maybe based on charitable donations, and you get money back based on that tax credit. So again, to summarize, the tax deductions are to shrink your taxable income. And then once your taxable income has been determined and we determine how much you owe, the credits now then shrink the taxes owed. Okay. Any questions about that before I move on? Okay, gonna move on. So this is a concept that I hear a lot of misconceptions about. I hear often people say, "Oh, Canada, the taxes are too high. Don't earn too much money." Sorry. Don't earn too much money because they'll tax you too much. And yes, but like I said before, there are strategies to try and minimize your taxes as much as possible. Please don't limit yourself because you don't want to get taxed. I mean, that's not a wealth building strategy by any means at all. The idea is to earn as much as you can and then minimize your taxes using legal strategies that are available to us. So the Canadian taxation structure is what we call it's what we call progressive or marginal. We're going to talk about that a little bit. But I want to explain that, first of all, there's a provincial tax. Sorry, first of all, there's a federal tax, and then there's a provincial tax. And this is why you hear people saying that certain provinces are better because of taxes. For example, Alberta, we know that, or you may or may not know that Alberta has low taxes in general, right? And so people might opt to live in a province like Alberta because, like I say, your taxes will end up being your biggest expense. I like to say that there are three main killers of wealth, right? One is taxes, 2 is inflation, and 3 are fees. So taxes, inflation, are fees. And so you really want to optimize all of that as much as possible. So the federal tax bracket, it's marginal, like I said, so it's based on income. We're going to talk about that a little bit. So these are the federal taxes based on income. So if you earn, so if you earn 50,000 and below, you're taxed at 15%. And then it goes on and on. I have some examples, an example coming up. So I just wanted to explain to you that there are federal taxes and there are also provincial taxes. So this is what it looks like for Ontario. And this actually changes every year. The government helps us by adjusting for inflation. So that way we are not really getting hit too hard by taxes. So as inflation happens this year, about 6% or so is what they're saying for inflation, they adjust the percentages so that the percentages, and they adjust the values of income just so that we're not getting too hit hard with taxes, okay? So if we look at the Ontario provincial taxes, so even though it says 2022, remember that we're filing in 2023, we're filing for taxes from 2022. So these are the 2022, this is what we are going to be, as we're filing our taxes now, these are the percentages that are going to apply to us here in Ontario. And it's different for different provinces. If you just go online, TurboTax is where I got this particular chart from. If you go online, and you Google provincial taxes and federal taxes, insert province, it'll show up for you so that you can have an idea of how much taxes you're going to be charged. So for Ontario, let's go to the highest income bracket, which is anything over 221,000 or so. Let's just say 220,000. You're going to be taxed at the federal rate of 33%. And then you're going to be taxed at the provincial rate of 13.16%. Together, that comes to 46.16%. Which is a lot, right? That's a lot. But the biggest misconception that I see, and the biggest mistake that I see people making, is that they apply the 46% directly to their income. All right. So let's just, to keep things simple, do you have your calculators? I want you to let me know. What are the taxes? What do you think the taxes owed for someone who lives in Ontario? If they earn an income of 100K, what do you think their taxes would be if their marginal tax rate is 46.16%? Don't Google it, but if you were even just to give me an approximation, what do you think their taxes would be if their income is 100K, the marginal tax rate is 46.16%? You may have already figured it out, but what do you think it might be? Or maybe I should ask this, what do you think most people would say it is? And you can put it in the chat if you're unable to unmute. Any ideas? Okay. Based on my experience, people would say about $50,000. That's basically the quick math that people do in their head. Okay, the tax rate is about 50%. Looks like somebody answered. Can you show the slide on Ontario taxes, Abiola? Okay, yeah, that's it. Don't bother trying to calculate it if that's what you're doing. Abiola is a teacher, so she already knows that it's not as simple as applying 46% to 100K. So most people, though, the average person that you ask, believe me, would say, oh, if I earn 100K, the government is going to take 46%. I'm only going to be left with 50% approximately, which is not entirely true. And this is why I wanted to explain the marginal tax rates and how it works, okay? So it's a graduated system. It's a graduated system. It's not something that just applies to the entire amount. It's a graduated system. And one easy way to try and remember it, the analogy that I like to use is that every dollar that you earn is not equal, meaning that the first so I've just rounded up these numbers for easy math, but the first 20K, call them the juniors, right? That's junior money. Then the next 20K, so between 20K and 40K, okay, we're starting to get more senior. From 40K to 60K, okay, we're graduating. From 60K to 80K, okay, we're getting higher. And then from 80K and above, those are the seniors of the seniors. Everybody doesn't get taxed. Every dollar doesn't get taxed to the same degree. Okay. So up to 20% will be taxed at 5%. From 20% to, in fact, let me just share the example. But when you are asked about your marginal tax rate, you would be quoting the highest number, right? So that's why it becomes confusing, because you ask people, okay, what's your marginal tax rate? Okay, it's 46%. Automatically, they think that the 46% is applied to all their dollars. That's not the case. It's graduated. So the junior dollars are taxed lower and the senior dollars are taxed higher. So this is the example that I wanted to share. But remember when we did the rough calculation, it was about 50K. If you just did the rough calculation, you might guess that the taxes owed on $100,000 is 50,000, because, okay, approximately 50%, 50,000, but it's not that simple. What you would do, and again, you don't have to do this by hand because there are tons of calculators available, but it's still important to understand the concept behind the numbers, okay? So for, like I said, the first 20K is charged at 5%, taxed at 5%, so that it's $1,000. And math is not my strong suit. So if there are any calculations that are wrong, please point them out and we'll adjust it. But I hope you just get the general principle. Okay, Fumi, you have a question? Go ahead.
Yes, please. Can I just take you back to income earned outside Canada?
Okay, yes.
I'll ask my question directly.
Okay.
So we came into Canada in May of last year.
Okay.
Does it mean that we're going to pay tax on income earned in Nigeria before? Okay, so I think I've answered my question. We won't pay we won't pay tax on income earned before we became permanent residents,
No.
right?
So it's
Okay.
while you are here. So anything earned, so say you came May 2022, anything earned January, February, March, April, up until May 2022 is not included. Okay. So it's money that you earn while you are a resident of Canada, but you're earning money in other places. Okay.
Okay.
That makes sense. Okay.
Yeah.
All right.
Thank
All right. You're welcome. Okay. So, okay, yeah, so at the example, so the junior money, let's call it that, the junior money is going to be taxed at 5% to give $1,000. Then the more senior will be taxed at 10% to give $2,000. Then the other senior money will be taxed at 20% to give $4,000, and then so on and so on and so on. So your taxes owed actually come to 21,000 as opposed to the 46,000 that people might have guessed. All right. So your taxes are based on this graduated system. All right. And you pay the most tax on your most senior dollars. All right. So then, I mean, at the end of the day, 21,000 is still a lot of money, especially if you're earning a higher income, right? But like I said, the goal is to still try and not pay more taxes than you need to. And one strategy is to maximize all your tax deductions, maximize all your tax credits. Because like I say, once we've calculated this amount, then the tax deduction will start to apply. So say you contributed to your RRSP, say you contributed 10,000 to your RRSP, just an example, your sorry, no, this isn't, sorry. sorry, this isn't taxes owed. This shouldn't say taxes owed. This should say taxable income. No, 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 no. It is taxes owed. It's taxes owed. Sorry, it's taxes owed. I joined late. Can we get access? Yes, yes. They look very neat, by the way. Thank you. Yes, and you can get access to these slides. I'll let you know how to get access to the slides. Okay. So yeah, taxes owed 21,000. But remember that you would apply tax deductions, right, to bring that down. Then we would also apply tax credits to bring that down even more. Okay. The tax deductions would bring down your taxable income. So say, for example, you earned 100,000 and you contributed 10,000 to your RRSP. So that would make your taxable income at the top here 90,000. And then from there, we would then calculate the marginal tax rate. After the taxes owed have been calculated, then we would apply the tax credits to bring that down even further. So you're getting deductions on either side of your marginal tax rate calculation. You get the deduction before your marginal tax rate is calculated, then you get the credits after your marginal tax rate is calculated and your taxes owed have been determined. So one of the strategies that I really wanted to talk about when it comes to maximizing your tax returns, paying as little taxes as possible, is to use your tax sheltered account. I'm not going to go into too much detail about that today, but definitely in a future session, I'm going to talk about what tax sheltered accounts are and how to really think about them and conceptualize them. So tax sheltered accounts, again, are vehicles that the government has generously given to us such that we can put our money into these tax sheltered accounts and kind of protect them from being taxed. So we either protect them from being taxed forever, or we protect them from being taxed. We defer the tax way, way, way into the future. So the tax-free savings account, which is one of my favorite tax sheltered accounts, that's the one where if you put your money inside and the money grows and grows and grows. Remember I said that your investment income can be taxed. These the income that comes from these tax sheltered accounts won't be taxed either forever or at a deferred time. So the tax-free savings account, whatever money you put inside, remember, you're not just parking it there. Please don't just park your money in these savings accounts. Please, 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 please don't do that. You must invest the money. You must invest the money so that the money can grow. So say, for example, you invested $10,000 into your tax-free savings account, and over the course of 3 years, there's this like incredible boom in the stock market and it grows to 20,000. That additional 10,000 that you have earned is completely tax-free money. It's completely tax-free money. I remember I said that the 3 biggest killers for wealth are your taxes, fees, and inflation. The more you can put into your tax-free savings account and put it in a healthy investment that's going to grow, you're not going to pay taxes on that money. It's incredible, right? And so that's one wealth building strategy that a lot of people will use, in that they will put investments that they know or they can sort of tell will grow fast and grow well and grow healthy, because they know that whatever they earn on that money is not taxable. It's not taxable. All right. Other tax sheltered accounts, by the way, another name for tax sheltered accounts are registered accounts. So you'll hear registered account, tax sheltered account means the same thing. So RDSP. So RDSP is available to anyone who has a disability. Again, you can put money in that account and it can be invested and it will grow. So you're not going to get taxed year after year after year. But I believe that for the RDSP, once you decide to withdraw the money and use it, then it's going to be taxed. So that means tax is deferred. Okay, so it's deferred. An RRSP, so your registered retirement savings plan. And I just want to emphasize that the fact that all of these have savings, it's a very misleading name, because you really don't want to just be saving in these accounts. Like I said, you want to be investing in these accounts. So they should be called the tax-free investment account, the registered disability investment plan, right? So the fact that it's savings, I don't want you to get confused by that, because you really should be investing the money that's in there, okay? So the RRSP, so the RRSP is a registered retirement savings plan. This is the one that also has the benefit that whenever you put money into your RRSP, it reduces your taxable income. So like I said before, if you're earning 100,000 and you put 10,000 in your RRSP, your taxable income for that year is going to drop by 10,000. So I highly, especially if you're earning a high income, I highly encourage you to at least put some money in the RRSP so that you can try and come down to a lower marginal tax bracket to the best of your ability. The difference between the RRSP and the tax-free savings account is that once you start to withdraw money from your RRSP, then you get taxed. Okay, unlike the TFSA where the money can grow, you can withdraw it, you can put it back, no problem, no taxes. The RRSP, it's tax deferred. It's not no tax, it's tax deferred, meaning that when you now withdraw the money, then you get taxed. The thing though is that you have to be very certain when you put that money in the RRSP that you're not going to pull it out until retirement, because if you pull it out before retirement, the government is going to tax you and fine you very highly, right? So whatever gains you have made in your investment, it's going to end up, excuse me, negating that because you have either withdrawn too early. So the RRSP, it's important to note that it's not money that you can just withdraw and put back and withdraw and put back like the tax-free savings account. The RRSP, once it's there for your retirement. And then once you reach the age of, I believe, 71 or somewhere about there, it then switches over to an income fund, meaning that the government makes you, it's mandatory to now start withdrawing once you hit, I believe it's around age 71. The RESP, I also love this account. Why? Because it comes with free money. The government will give you, so the RESP is a registered education savings plan. And for whatever money that you put into the savings plan, the government will match it. And I believe it's up to $500 a year. Over the lifetime of your RESP, the government will give you $7,200. Right? But that's split up over, I believe, 14 years or so, right? So when you contribute to the RESP every year for your child, the government will then give you free money. And I mean, who doesn't like free money, right? And then finally, the first home savings account, I believe that's what FHAC stands for, first home savings account. This is actually a new registered account that the government implemented of December of 2022. And what they're doing is that they're encouraging people, if it's your first home, to contribute to this account. You can invest the money can grow, and it's tax-free. It's tax sheltered, it's tax deferred, I should say. You are going to get taxed on it once you withdraw the money, but this is another nice, and you must use the money for a house, right? This is another nice way to, again, defer your taxes until the time that you actually need the money, and the money can grow as you invest it. Okay, so I see a question in the chat. Okay, yeah, so somebody said, I thought you could use your funds from your RSP for real estate investments and it won't be taxed. So yeah, so that's also a strategy. I don't want to get too bogged down into the details, but yes, but it's not just any kind of real estate. It must be the first home. Okay, I believe it must be the first home, and I might be mistaken, but you can't pull out, say you want to invest in a rental property, you can't pull out your RSP and say that you want to use that money for a rental property because it's going to be taxed. But there is and you have to pay the money back as well. there's a name for that incentive. I can't remember what it is off the top of my head, but there's a name of that incentive where you can borrow money from your RRSP, but you have to pay it back. Okay. And it has to be I'm pretty sure it's for your first home. I'm pretty sure it's for your first home. Not so if you've already bought a first home, you can't use that incentive again. I'm pretty sure it's for your first home, but I will check before the end of today and let you know for sure. Okay. I hope that answers that question. So, some helpful resources that I've used over the years. So it's interesting. I went into my CRA account. So Canada.ca. Please register for Canada.ca because that is where you can see all your employment history, how much you have, how much contribution room you have in your TFSA, because the contribution room increase yes, but generally they increase over the years. Sometimes they bring it down, but generally it increases over the years. I believe this year it's $6,000 for your tax-free savings account. So you can contribute up to $6,000 for your tax-free savings account. But say you've been working for 5 years and you haven't been contributing to your tax-free savings account, you have all of that accumulation of contribution room. But it's hard to remember all those numbers. So if you go to Canada.ca and set up an account for individuals, all of that history is going to be there. One thing that I did 2 weeks ago or so is I actually went back as far as when I started working as a resident. That was the first time, the first record of taxes I have. So that was 2012, no, 2011 or so. And what I did was I added up all my income over the years that I've been working. So things like that are very interesting to look at. It just is a snapshot of your income taxes, your income, how much contribution room you have in your registered accounts, etc. So I highly encourage everyone to set up an account with Canada.ca. You also want a system for tracking your income and expenses, right? Like I said before, if you like to use pen and paper, go ahead and use pen and paper. If you like to use spreadsheets, go ahead and use spreadsheets, especially if you're self-employed. So for someone like me, I'm self-employed. I have multiple things that I'm doing for income, speaking engagements. I work in urgent care in different places. And so income is coming in from different places. If I'm not keeping track, it's going to be very challenging for me to start looking for all the documents and my checks and my receipts and all of that at the end of the tax season, right? So keeping everything in one place is helpful. Like I said, having a file folder for your important receipts and tax documents, so that when you need everything, it's available. So my taxing history, the first time I filed my taxes was through H&R Block, and I really had a good experience. So H&R Block, I think then they didn't have any online stuff, but now they have online capacity. So I would go in, I would take all my paperwork to H&R Block, I would leave it there, they would file it for me, and then I was getting a refund because I was paying taxes and my income wasn't high. So I was getting a refund then. So H&R Block is a great place, very reputable, trustworthy, and I've always had good experiences with them. And I'm sure, obviously, do your due diligence. If you're looking for an H&R Block near you, Google the reviews. If you feel like the accountant that you've been matched with or the tax professional you've been matched with isn't really a good fit, use that sense as well and look for somebody else, right? So just because I had a great experience, you also have to do your due diligence. TurboTax is another software that I've used many times. So after H&R, so I would sometimes alternate when I was a resident. And bear in mind that my taxes were very simple then. So fairly easy, fairly straightforward for me to do. I would alternate. So I used H&R Block for about 3 or 4 years. Then I would use TurboTax. And I actually used TurboTax again recently for my 2020 20 taxes. So in 2021, I used TurboTax. And what I did was I just inputted everything to see what my tax return was that year. And what I did the same thing with my accountant, it matched. In fact, my accountant had missed something. And because I saw that my TurboTax return was higher when I did it myself, I was like, okay, there are some things that my accountant, I think it was actually my fault that I didn't send them certain documents, so they didn't incorporate it. But at the end of the day, the numbers matched. So things like H&R Block, TurboTax are very good, especially if your taxes are very simple. But of course, I would recommend a very good accountant. Once our taxes started to get more complicated with real estate and all of those things, we had an accountant. And so the accountant every year sends us the forms that we need to fill, and then we fill it and send it back. My husband is also a US citizen, so that makes his taxes a little bit more complicated. So I wouldn't recommend, once your taxes start to get incorporated, once your taxes start to get more complicated, certainly if you're incorporated, you should have a very good accountant. What does very good mean? Very good means someone who's going to save you money at the end of the day, right? Somebody who is invested in minimizing your taxes. You don't want somebody who is just willy-nilly, somebody who knows what the tax credits are and what you might be eligible for. And of course, someone who's going to educate you. I'm not a fan of financial professionals that say, no, don't worry, they brush you off or they make you feel bad for answering questions. Those are red flags to me when it comes to financial professional. So very good, somebody who is invested in minimizing your taxes for you, someone who will educate you and will listen to you when you ask your questions. Someone who's also accessible, because that's the worst thing is when you need your accountant and they are not responding, that's also a red flag too. All right, so we've come to the end of the presentation. I'm going to stop sharing my screen for now. And I want to open the floor to questions. I know it was a lot of information, but what questions might you have? What questions do you have? So I'm going to address the question that came up regarding the RRSP and the home buyer's plan. The RRSP and buying a house. Okay, so yes, so like I said, it is for your first home. It's for your first home, all right? So buying or building your first home. And if you have up to $35,000, so again, it's one of those things that changes from year to year. If you have up to $35,000 in your RRSP, you can withdraw that money. Again, it doesn't have to be $35,000. It's up to $35,000, right? You can withdraw that money, put it towards your house, buying a house, building your house. It has to be your first home. And that's your first home across Canada. So if you bought a house in Winnipeg and sold it, you moved to Ontario, which was our case, we don't qualify for that. It has to be your first home. And like I say, you have to pay it back. You have to pay it back the second year after you withdrew your money. So if you used it in 2022, you would have to pay it back in 2024. You start paying it back in 2024. Okay, I hope that answers that question. Okay, I see Abiola has a question. All right, go ahead.
Thank you very much it was a lot of information. It was very good.
You're welcome.
My question is on the tax deductibles. Can you go back to the slides, please? Because you had a list of difference.
Sure, I will do that. Okay, so you wanted the slides with all the list of
yes, please.
this one. Yeah.
Yes. How do you know when you're eligible for some? So, for example, I was just wondering, there was one on climate. How do you
Okay,
know,
yeah.
like, yeah.
So that applies to everybody. That applies to
That's
everybody. So
great.
everybody's eligible for that. It's just that you would have to pick one person. Like, so two of you are, and say you have a spouse, one person has to do it. So it's usually I or my husband that does it. And the person with the higher income, it's recommended that the person with the higher income does it so that they have less taxes to pay. So what happens is, as you're filing your taxes, for example, if you're using H&R Block or TurboTax, or if you're using an accountant, they ask you the question. So you don't have to really remember everything. They'll ask you the questions as you're going. Did you work from home? In 2022, did you sell a house? Did you move? Do you have children in childcare? Did you receive spousal support? They'll ask you the questions as you're going through the process. And if you have a good accountant too, they will definitely ask you. So when the climate action incentive first came, we didn't say anything, but our accountant sent us a message saying, usually, so Cordia and my husband and I use different accountants because he files with someone who has expertise with US taxes. So my accountant will usually ask, did your husband file for the climate action incentive? And his accountant will also ask, did your wife file for the climate action incentive? And then they'll determine, okay, whose income was higher that year, and whoever's income was higher that year gets the deduction. So long story short, you don't have to worry about remembering everything, just that as you're filing your taxes, it takes you through the process of asking, did you contribute to your RRSP? Did you withdraw from your RRSP? All those things are all part of that. Okay. It'll ask you, what are your business expenses? Do you have a business? All of those things. Okay. Does that answer your question?
Yes, it does. Thank you.
Yes. Tony says your province will also determine. Yeah, that's true. That's true. So I'm in Ontario and it applies to us. Yeah, that's true. And all the provinces are different too. So this is why it's important to have an accountant that is licensed in your province, because they will know. I mean, I don't even know if accountants can do all of those different things, but they will know what you qualify for. I think when we lived in Manitoba, there was when we were renting, there was even a renter's tax, which I don't think is available to us here. All right. Okay, I see more questions. Who uploads the information on Canada.ca? Us or the government? The government does. The government does. So whenever you file your taxes, everything is automatically uploaded. So you don't have to worry about uploading any of that. The government does all of that. So I have a question here. It was a direct message, so I'll keep the person anonymous. You're welcome. Recently landed and didn't work in 2022. My husband, however, worked for about 4 months. Will I be filing nil tax? I don't understand what nil tax means, but you would please still file for taxes, and this is why. You might be eligible for a refund. So even if just speak to H&R Block or speak to someone, call them or ask them. But I believe that you could still file taxes, and possibly be eligible for a refund if you didn't work. And the reason I say that is because there is a minimum amount, there's an amount of money, about $15,000 that you get credits for, right? So if you earn less than $15,000 or less, you can actually get a credit and potentially get a refund. But don't quote me on that. My best advice would be to speak to someone at H&R Block or TurboTax. I've called TurboTax before, and they've been very helpful. They connect you. You can ask to be connected to a CPA, so certified finance. No, is it CPA or CFP? No, CPA, an accountant. Yes, a certified professional accountant, and they will actually answer your question. So I believe that it might be beneficial for you to actually file your taxes, even if you didn't earn an income. Yes. Okay. Right. Any other questions? The more you file your taxes, and the thing is that it's also learning by doing, right? The more you file your taxes, the more you ask questions. So I've been in Canada for 20, it'll be 23 years this year. And I filed taxes for probably almost half of that time. And so everything that I've shared today is just based on the years over and over, the things that I've done over and over, my experience over and over. But the most important thing, and I hope that what you're going away with today is that it shouldn't be intimidating. I was sharing with the ladies on Sunday that that I'm actually excited to file my taxes this year because this is the first year. Last year was the first year of my practice, and think a lot of things changed. I'm excited to see how everything falls into place for us. And so please don't be intimidated by filing your taxes. Taxes are very important, and the more you understand them, the more you're able to build your wealth, because the more you're able to minimize your taxes, right? More you're able to minimize your taxes. So as a newcomer, do you recommend doing it yourself? I would advise no, that you can experiment. Say, for example, I think TurboTax, unless you complete the filing, they don't charge you. At least that was the case 2 years ago. So you can experiment and just, log on to H&R Block or TurboTax. If they don't charge you, go ahead and just experiment. But I would recommend that you actually use somebody to file your taxes, at least for the first time, so that you can get a sense of what's needed, what might be missing. You have someone to ask questions to. That would be my recommendation, is that you, for the first maybe 1 or 2 years, you have someone file it for you, but it might actually boost your confidence if you use something like TurboTax and input all your values and see if there's any discrepancies, like what the difference is, because that's how you will learn more about taxes. So iPhone Pro, I don't know who you are. Who's iPhone Pro? But thank you so much for your contributions and your questions. Wealthsimple also offers an online platform that allows you to file yourself, and it's pretty straightforward. Awesome. I didn't know that. I love Wealthsimple. We invest partly through Wealthsimple, and they have a lot of great educational information on their website. So Wealthsimple is also another option. Thank you for sharing that. All right. Any other questions? Okay, so I'm going to wrap up now. Thank you so much, everyone, for joining. What I'm going to do is the recordings, the slides, everything will be available. I'll put a link in. Okay, so if there are some people whose names I don't recognize. Many of you, I know you and recognize you, but if you're not following me on Instagram, because that's where I announced the session today, I guess, unless someone forwarded it to you, you might already follow me. I have a podcast, feel free to listen to, but what I really wanted to share was our Telegram group. Because our Telegram group, that was when, Funmi asked the question in our Sunday meeting. She asked the question and I took her up on the request. And so that's where you would have access. It's more of like an inner circle. It's completely free to join. And I share voice notes every week. We have, it's faith-based, okay? So I'm Christian, it's faith-based. We have a planning and prayer session on Sundays. And so I would invite you to join. if you're interested, because I hope to do more of these in the future. All right, and that's it. That's it. Thank you for coming. Thank you for joining.
Thank you so much.
You're welcome. And if you think of any questions, please go ahead and put them in our group and I'll answer it. All right, ladies, have a great weekend. And I'll see you in the group.
Thank you very much.
You're
Thank
very
you.
welcome. My pleasure. My pleasure. It's my pleasure. Bye.